The broadcast is now starting. All attendees are in listen-only mode.
Right, good afternoon, everybody. Welcome to 2019. This is my first webinar, my monthly market update for Standard Bank Securities for this year, and I look forward to many more of these with you throughout the rest of this year. Just before we get started, can I just, as a show of hands, see that everybody can hear me? If you can raise your hands, your digital hands. Good. I see plenty of hands going up, so that sounds great. All right, fantastic. I'm going to get started. This month's webinar is a little bit different to the template that I typically follow. And the reason I've done it differently this month is because I spent some time during the December holidays looking at my sort of market strategy, my outlook for the rest of the year. You know, I read a lot, I consume a lot of research and broker reports and economic reports and interesting things. And, you know, it can be quite, you can get quite a lot of contradictory information. And I spent a bit of time trying to try and formulate some sort of an action plan or strategy to try and use as a template for the rest of this year. So I'm going to go through that and effectively take you through my thinking and what my conclusions were following that exercise. From next month, I'll then resume back to the same sort of template that I followed each month of last year, at the various different indices and a lot of charts and things. This month's webinar is going to have, you know, quite a lot more just talking and me talking over the slides and fewer charts than what we used to, but I hope you'll find it interesting. And I'll aim to go for probably about 40 minutes, and then we will leave some time open at the end for questions and answers. All right, so let's get straight into it. The contents are as follows. I'm going to be looking at the S&P 500 quite closely and looking at an analysis of prior bear markets to try and see if there's some similarities to what we're seeing in the markets at the moment. I'm also going to draw the global economic landscape in terms of where we are now and how I see things at the moment. I see globally and then look at the risks locally for 2019, and then following all of that, I'll put down a bit of an action plan and a strategy to try and follow for the rest of this year, and then we'll open the question and answer session after that. All right, so this is the weekly chart of the S&P 500 that goes back effectively 2 decades. You can see the prior bull markets and bear markets quite clearly there. We had a bull market that ran up to the Y2K boom in 2000, and then of course we had a bear market that followed that until 2003. Then we had a nice powerful bull market up until 2008. Then we had the financial crisis into 2009, and then we've had quite a strong bull market basically for the last decade, really, with a little bit of a period in time in 2015 and 2016 where the market had a bit of a wobble, but it managed to continue upwards after that. Now, for me, this is my sort of starting point of this webinar, and why I'm going to start here is because this, to me, I mean, the S&P 500, as we know, is the biggest equity index in the world, and very much, you know, the rest of the world will tend to be led by what happens in the US to a certain extent. Now, what I've noticed here is that the 50-week moving average on the S&P 500 has been a very, very reliable indicator of whether you're actually in a bull market or a bear market. You know, a lot of the technical definition of a bear market is when they say it's minus 20% or more. But now I think that's, to me, that's nonsense. I would prefer to say, are we in a bear market? Look at the behavior of the market, you know, and determine from there whether you're in a bull market or a bear market. And the direction of this 50-week moving average on the S&P 500 has been very, very reliable at telling us whether we're in a bull market or a bear market. So there you can see the bull market that 2000 going in. Moving average began to turn up in 2003, and that started the next bull market that ran for another 5 years after that. Then in late 2007, early 2008, the 50-week moving average began to turn negative. And you can see that turning down there, and that was the start of the bear market that led to the ultimately what was the financial crisis. And then in '09, we saw the 50-week moving average turning up again, and that started the next bull market. In late 2015 and into early 2016, I see some people are saying intermittent sound problem. Okay, I hope it's not a problem. I hope this is not going to continue, but I see somebody now saying it's back on. So let's carry on. In 2015, 2016, there was a blip at that point where the 50-week moving average began to turn negative slightly. But then what happened is the Fed came on and they effectively pumped a whole lot more stimulus back into the markets, and then we saw the bull market continuing for another 3 years after that. Now, what's very interesting, and why I bring this up now, is because after that sell-off that we saw at the end of last year, the 50-week S&P 500 has fundamentally around the world. I think this is something very much worth paying attention to, because it suggests to me that we might actually be in the early stages of starting a new bear market potentially. So I want to now go and look at each of those prior bear markets and how they started, and see intermittent sound break. Can someone else, just a few other people, pop it in the questions box if you are having sound issues? Let us know, because I see there's 3 people that have made a mention of a sound issue. Okay. Unfortunately, I don't really know what to do about that. I can't say where. Yeah, I see plenty of you are having sound issues. I can't say what's causing it, unfortunately. I don't know if it's something on my side, if it's something to do with the internet connection. So I'm going to just carry on, I'm afraid, and hope that it improves. Right. I'm going to take a look at each of the bear markets in the last 2 decades, and we will and unpack them and then bring it back to what we're seeing right now and see whether there's some sort of similarity. So let's first start out with the bear market of 2000 to 2003. And here you can see quite clearly that the 50-week moving average began to turn to the downside in late 2000. And it continued downwards from then on. Now, what was notable is that there was a fairly significant technical break. We saw this upward trend breaking to the downside. And then you got a series of retests of the underside of the 50-week moving average in the months that followed, which were and those rallies were unable to break to the upside. And the 50-week moving average essentially provided resistance throughout the rest of that bear market. And there you can see it quite clearly. All right, so that was 2000 to 2003. Then let's have a look at 2007 to 2009. Here, again, notice at the end of 2007 and into the beginning of 2008, we saw the 50-week moving average beginning to turn negative, and that was the first time that had done that in 5 years. And you then, after a big break below what was then 1425 support on the S&P 500, that was a significant technical break, similar to what we've seen recently, in fact, on the S&P below 2600. Failed at the underside of that 50-week moving average again, and it provided perfect resistance before the next leg to the downside began. So that was a commonality between those two. And then let's look quickly at that period between 2015 and 2016, where I mentioned the market did briefly go bearish, but it didn't stay that way for very long, because what happened was the Fed came along and opened up the taps with more quantitative easing, and that effectively pushed the S&P 500, what was basically another 1,000 points higher in the 3 followed that wobble that we saw at the end of 2015. But again, there is still some sort of similarity here in the sense that when that 50-week moving average began to turn down, you did get quite a big throwback, and that 50-week moving average provided resistance again before another leg to the downside. So it's quite interesting, and that's why I pay a lot of attention to this 50-week moving average in terms of the in terms of whether it's indicating a bullish or bearish market environment. So now, where are we currently? This is the S&P 500 weekly chart as it stands at the moment, and you can see it looks back over effectively the last 2 years. What's quite clear is that that upward trend that we were following over the last 2 years and even before that. That upward trend broke to the downside quite aggressively in October last year. And we've also now begun to see the 50-week moving average begin to turn negative. As I mentioned, it turned negative in December last year when we had that big sell-off into the end of the year. Now, what's happening at the moment is the market is rallying. It is rebounding, and it's had quite a swift rebound. I mean, if we bottomed out at 2350, and it's currently sitting at about 2600 at the moment. The way I see it is the 50% retracement of that entire drop comes in at 2650. And the 61.8% retracement comes in at just above 2,700. And notice also that your 61% retracement coincides with the underside of the 50-week moving average again. So I'm going to be watching this very, very carefully in the weeks and possibly months ahead to see whether that 50-week moving average provides resistance again, as it has done in each of the prior bear markets. And if we start to falter at the underside of that 50-week moving average and we begin to form a weekly reversal down, then I think it's going to add further impetus to the argument that we could have actually started a new bear market. And do keep in mind, bear markets often can be volatile or are volatile, and you can often see some very big bounces. Often, in fact, some of the biggest rallies that you'll ever see invariably happen during a bear market kind of an environment. So this 10% rally that we've just seen off the lows now is not, not uncommon to see that sort of move in a bear market type of environment. So that kind of paints the picture technically rather for me to start out this webinar and to then take the story forward. So what I want to do next is now look at the landscape globally and highlight some of the issues. And as I said, I spent some time in the December holidays effectively filtering out what I felt were the biggest and most dominant themes that we need to be aware of right now as we enter 2019. So the first, of course, is that we are in a rising US interest rate environment. They've risen, rates in the US have been hiked a number of times over the last couple of years. There's now a question mark over whether we see further rate hikes or not. Powell is a hawk by nature. He's made it quite clear. He's also made it quite clear that he's there not to sustain asset bubbles. He's there to maintain the mandate of the Fed, which is employment and inflation. But before him, Janet Yellen and Ben Bernanke had these sort of not really official mandates, but almost that they were there to also try and prop up asset prices and prop up the markets. Focusing on those two mandates. So whether we get more US interest rate hikes this year or not is actually now debatable. The Fed funds futures are beginning to say no more hikes, but that's not, the Fed fund futures do sometimes get it wrong. So there remains a possibility that we could still get one or two more hikes at some stage during 2019. A lot of it is going to depend on the economic data that comes out. All right, so that is important. And just also do keep in mind that in the past, US recessions have always invariably been preceded by a rising US interest rate environment. So it's not to be ignored. All right, then the next point is the high level of indebtedness, particularly in the US, because of the low interest rate environment that has been in place for the last decade, really, since the financial crisis. What it has enabled companies to do is take on a huge amount of debt. And a lot of companies have really gorged on this cheap debt to try and fund their growth. A good example of of that is something like Anheuser-Busch, which took on enormous amounts of debt to go on and grow their business. From its peak. So high corporate debt is a risk, and I do wonder, whether that risk is not going to rise further as we go into 2019. And also, if the Fed does hike rates further, that obviously tightens the screws even more on those heavily indebted companies. Then US and China are late in their economic cycle. I just got a slide here to illustrate. I saw this on Twitter the other day, and I thought it was worth posting it here, just illustrating the size of the various different economies. So there you've got the US, which is the biggest in the world, 20% nearly a quarter of the world's GDP, and then you've got China sitting over there. So those are the two major economic powerhouses of the world. And the fact is that both of those economic powerhouses are very late in their economic cycle now and are beginning to show signs of deteriorating economic data. That is a little bit of a concern. And if you see a slowdown in those two economies, the reality is the rest of the world won't escape that. Just if you're interested, you can see South Africa is down at the bottom right of the chart here, 0.44% of the global economy. So we really are insignificant on a global scale. All right, then quantitative easing in the US. Essentially create liquidity into the system, which has been stimulative for the economy and stimulative for asset prices. That has ended. It ended some time back, and now the US is actually in the early stages of quantitative tightening. Hello? Right. The US is in the early stages of quantitative tightening now, which is essentially a reversal of that liquidity that has been injected into the markets over the last number of years and has helped the asset prices to move higher. So that is also a massive headwind for equity markets looking out this year and next year, I believe. Then also in Europe, the same story. They're also approaching the end of their quantitative easing cycle as well. So that also is essentially going to be taking the foot off the gas, as it were, in terms of the of economic stimulus that's been pumped into those markets as well. Then the next point is the US yield curve, which is approaching zero. And here we're talking about the 2-year versus the 10-year yield curve. And I show this slide each month. I'm going to show it again. The reason it's important is that your 2-year yield obviously is short-term rates and 10-year yield is long-term rates. And as you find that they converge on one another, if you get a flattening of that yield curve, very often, in fact not very often, almost every time that it has happened in the past, where you get the yield curve going below zero, in other words negative, where your 2-year rates are higher than your 10-year rates, that has always preceded a recession in the US. The gray shaded areas here on this chart indicate where the US was in recession, and you can see what happened prior. And it was not always immediately before, it was sometimes a year or 2 years even before. But when the yield curve going negative, it preceded a recession in each of those situations. Now, what we're seeing at the moment is this yield curve heading closer and closer and closer to zero. And if it does begin to invert, then I think, based on history, it suggests that we probably are poised for a recession in the US, either later this year or possibly 2020. The jury's out on when it would be, but I mean, I'm sort of in the camp that it would probably be 2020 only. But keep an eye on this yield curve. It's a very, very important thing to watch in terms of your potential for a recession in the US. All right, and then US stock valuations are off their recent highs, but they're not cheap still. So this next chart shows you here, this is a very long chart of the S&P 500. It goes back to the 1960s. And this bottom section of the chart here shows you the median price earnings ratio for the S&P 500. So this is the median. Just understand the median and the mean are different. The mean is effectively the average. The median is the midpoint. So in other words, if you've got 500 companies in the S&P 500, you want to find the middle PE ratio of that stock that's right in the middle. So you're going to have 250 companies that are cheaper or have a lower PE ratio, and you're going to have 250 companies that have a PE ratio that's higher. And you find the one that's right in the middle, and that is the median. Now, the recent sharp sell-off that we saw at the end of last year has seen reduce itself quite significantly. I mean, it's now sitting close to 20, whereas it was north of 25 just late last year. So it means that equity valuations have improved somewhat in the sense that there's a bit more value evident. And I suppose you could argue, if you go back over the last 2 decades, the S&P 500 median PE has been around about 20. There have been times where it's gone cheaper. We can see in 2011 it went cheaper. In 2008, in the financial crisis, it went a lot cheaper. So do keep that in mind. I mean, it's not, the US equity market is hugely overvalued, but it's certainly not a bargain either at the current level. And the question is, what sort of earnings growth are we likely to see from the US earning and effectively S&P 500 earnings looking out in the next couple of years. If those earnings do begin to stall and suffer because of the sort of the bigger backdrop that I've painted, you could actually find that this thing needs to still re-rate a bit more. All right, then the US dollar is also a big theme, and I see the US dollar remaining relatively firm, but probably being in a fairly choppy range. I'm seeing a lot of commentary out there saying that the US dollar is going to go, that the dollar's strength is over and it's only going to go lower from here. My issue with that is that the US at the moment is the one economy where you've got interest, you actually earn a bit of interest on your money in terms of the developed market economies I'm talking. So look at the European economies, look at Japan, etc. The US is the one that actually pays you a bit of money, a bit of interest on your money as things stand. So I think that has got to be a tailwind for US dollars. And the other thing is that with quantitative tightening happening in the US, what that essentially means is that dollars are basically being withdrawn from the system. So you're seeing, not a shortage, but a reduction in the number of dollars in circulation. And that surely, to me, also must indicate that the dollar remains relatively firm. So to the guys that are saying the US dollar is going to weaken substantially this year, I'm not convinced myself. I think, by saying that, you've then got to imply that other currencies in the US dollar index are going to strengthen meaningfully against the US dollar. And I'm not quite sure where that's going to come from. So I think what we could see quite feasibly is a choppy range where we go down towards this 93.50 support area on the US dollar index. That has been support through the latter half of last year, and then a resistance is up here at 97. And I suspect we could chop up and down in range boundaries. But I'm not in the camp that says the US dollar is going substantially weaker. I can't agree with that on the basis of what I've said already. Right, then US growth is slowing, and we do see the potential for a recession either late this year or potentially in 2020. Like I said to you, you look at that yield curve, and that's pointing to a risk that potentially we see a recession coming at some stage. And also just look at the economic data that's been coming out recently in the US. It does indicate that there is a certain level of slowing in the US economy, and one does get the feeling that these higher US interests are now starting to bite a little bit. All right, then trade wars, obviously that's ongoing between the US and China particularly. They are right now busy negotiating as we speak, and there was sort of a truce called on the trade war for the next 90 days, which takes us out to March sometime. And during that time, hopefully the US and China can come up with some sort of a resolution that works for both parties. Because I think at the end of the day, because these are two global economic powerhouses jostling for position, one would think that they probably would both want some sort of a deal to be reached. A trade war doesn't really benefit anybody. So let's hope that they do find some sort of a resolution during the next couple of weeks or leading up into March. But certainly seems from both sides that they're playing hardball. So it's going to be an interesting and hard-fought negotiation there. If the trade wars do continue, in other words, if there's not an amicable resolution and the trade war escalates, I think that would be very negative for markets. If we do see a situation where they come to some sort of an amicable arrangement, maybe the markets do breathe a little bit of a sigh of relief on that. All right, and then things that are in the base already are the US tax cuts. Remember when Donald Trump came into office, and that was stimulative for the economy. It increased, has now been felt already, and that marginal benefit won't be felt anymore from this year onwards. So that's in the base. And then the other thing also is that share buybacks have been a huge theme over the last number of years, because whilst interest rates have been so low in the US, it has afforded companies the ability to essentially borrow money and buy back their shares. And they've reduced the number of shares in issue in their companies, and that in itself has helped to boost earnings per share. And that is probably also largely in the base now, particularly with higher US interest rates. It makes the argument for share buybacks less compelling. All right, and then finally is Brexit uncertainty. So we're right in the very thick of that at the moment. Obviously, we know last night Theresa May survived the vote of no confidence against her, and the day before that, her Brexit deal was voted down. So it really leaves the scenarios, there's multiple possible scenarios now for Brexit. Immediately, it seems she needs to go back to the European Union, see if she can get some concessions, maybe a slightly better deal to take back to her parliament. But quite honestly, the way that she was, the way she did that vote on Tuesday evening, I don't know that she's going to be able to come back with anything that her parliament approves. So it's very, very interesting, and there's all sorts of possibilities here, from calling another general election to a second referendum, maybe. And the possibilities really are quite, there's plenty of possibilities here. And that uncertainty remains with us, and it's probably going to remain with us for some time. The clock is ticking. They need to, if nothing else, they leave the European Union on the 29th of March. But one does get the sense that between now and then, either they'll delay Brexit or some sort of development will happen. I think now you're going to start to see it taking some very interesting twists and turns. All right, so then just laying that background as I've spelt it out there, and then coming back to this chart of the S&P 500, given once again what I said about the fact that the 50-week moving average has begun to turn over, the technicals have certainly started to show a lot more volatility, which is quite common to see at the end of a bull market and at the start of a new bear market. It does make me wary for this year. It really does. So just keep this in mind in terms of the backdrop of how we're seeing markets currently for 2019. All right, then let's look at some of the global risks for this year. As I said, corporate debt is large, and it could be a problem. I think it was Warren Buffett who said that you only see who's been swimming naked when the tide goes out. And I think we're going to start to potentially see that this year as the higher interest rates in the US bite, and some of these companies that have gorged on cheap debt start to find it difficult to live with that cheap debt. So look at companies that are very, very heavily indebted, and those are the ones that could potentially face a bit of trouble. So a company like Tesla still springs to mind for me. That's a very, very heavily indebted company, and although they've been up and what have you, the fact remains that they are very, very heavily indebted, and that's the type of company that potentially could start to feel the pinch of these higher rates. So just keep that in mind as a theme for this year, as a risk. Then the other risk is that the US yield curve inverts, like I said, and that it could precede a recession in 2020. The other risk, of course, is that the Fed over-tightens rates. If we do see Jerome Powell coming out with his hawkish nature and being aggressive on hiking rates, another 2 times this year, the question is, will he overdo it? Will he over-tighten rates? So that's a potential risk for this year. And then a disorderly Brexit, which at the moment it's looking as if it might be heading in that direction, but who knows? But a risk there could be that a disorderly Brexit causes some waves, and it causes the pound to crash down to between 110 and 115 to the US dollar. Keep in mind at the moment it trades at about 1.28, so that would be a fairly big move to the downside if the pound crashed to that sort of level. And then the other risk is if the US and China trade wars escalate. I must say at this point it seems as if that is a remote possibility, and more likely is that they seem to be trying to come to some sort of a amicable arrangement. So I think this is a fairly low risk. But if the US trade war were to escalate with China, then I think that is a big risk for equity markets in 2019. And then another risk is that China slows down more than expected. We are seeing evidence of China slowing down, but then the Chinese authorities are always very quick to try and get involved and try and quell a downturn. So we're seeing potentially tax cuts being talked about in China now, and other sort of stimulus measures being implemented to try and give that economy a bit of a boost. All right, so that's the global markets backdrop as I see it, highlighting some of the biggest themes and the biggest risks that we faced with this year in the markets. Let's now bring it back locally and have a look at what the landscape looks like for us in South Africa. So of course the big event for us this year is going to be the election in May, and I think we're going to be in a holding pattern until then. In other words, a lot of people are saying we will wait and see what happens with this election. We'll wait and see what the outcome is, and only after that maybe we'll start to put some money to work and invest a little bit. Everything I've read seems to suggest that the see in this year's election goals at every opportunity. So I think their popularity is dwindling a little bit, and I see the DA at 20% and the EFF probably at about 9%, and then the rest of the parties, all the smaller parties, making up about 11% of the vote. But the thing is that the fact that we've got to wait until May for that is a little bit of an issue. It just means that we could see more of this Groundhog Day type of environment that we're sitting in South Africa at the moment, ongoing for a few more months. All right, then I still think we are vulnerable to a downgrade to full junk status this year or next year. Our state-owned entities remain an absolute mess. Eskom is obviously leading the charge in terms of that mess. Their financials are an absolute shambles, needing upwards of 100 billion rand in assistance, it seems. And wanting to possibly pass some of that debt onto the government. So those kind of things, rising the debt level and combined with a slow economic outlook, etc., to me that is sort of something that Moody's would probably start to become quite frustrated with. I think Moody's is the last of the ratings agencies that still has us at an investment grade rating, but we're one notch above junk status with Moody's. The other two, Fitch and Standard & Poor's, both have us at junk status. So it only takes Moody's to downgrade us to junk status, and then we've got a full house of junk, and that has all sorts of implications in terms of our standing in the World Government Bond Index, etc. We could see some selling out of our bond market. So keep that in mind. And also Christine Lagarde from the IMF was here in December, and that trip of hers went without much notice, but she did issue all sorts of what South Africa needs to do to get its house in order. Discussions about at some stage an IMF bailout needing to happen. There are commentators out there who still feel that we might at some point go down the road where we end up needing an IMF bailout. So anyway, the point I want to make here is that I think this year we still remain vulnerable to a downgrade to full junk status potentially. All right, the next question, of course, is this mostly priced in? Because where our bond market is, our R209 bond is yielding nearly 9% now. That's a pretty chunky yield. So the question then is this maybe priced into the system already? And I think to a large extent it probably is. And if we actually did get that downgrade, then the market would not necessarily react as negatively as people might expect it to. You may get a little bit of a knee-jerk reaction in the currency, but to keep in mind, in a place like Brazil, they were downgraded to junk and it was widely expected, and their currency actually strengthened afterwards. So it's not to say that if we do get downgraded to junk status that it's the end of the world either. Economic growth in South Africa looks as if it is still likely to remain slow, and I think also if we do begin to see further evidence of a global economic slowdown, we won't be able to escape that. What is sad, I think, for South Africa is we've effectively missed an entire economic cycle. If you look at the US and their economic cycle over the last decade and how they've grown, and a number of other countries as well, South Africa, we've really just gone nowhere in the last decade. Effectively, we've lost a decade under the Zuma leadership, and it's cost us an entire economic cycle. And what does worry me is that as we start to potentially get our act together in South Africa now, politically and in other ways, we then get faced with a global economic slowdown, and then that we won't be able to escape that. So that for me is a risk. Having said that, do keep in mind that corporates in South Africa have largely not investing on any grand scale. In cash. So just to give you an idea, I mean, that's a little bit short of an entire year's tax collection in South Africa that's sitting in cash on balance sheets in companies around the country. So if we were to see a situation where confidence returns and the companies feel comfortable again, you could actually see some of that cash being put to work. But I think we need to get the election out of the way before we start to see anything like that happen. All right, inflation seems to be remaining under control, below 6%, so that's good news as things stand. Eskom, load shedding is potentially likely to become more of a regular thing, which can't be good for the economy. I know they said that from the start of this week, from the 15th of January, there was potential that load shedding could resume again. And we managed to escape load shedding over the Christmas period, largely because obviously Pravin Gordhan came and wielded the big stick, but also industry slows down over that period. So it meant that the demand on the power grid was not as great, and therefore we were able to avoid load shedding during that time. As up again and as industry starts up again, I think you could find more pressure being put on the power grid. Certainly that's a lot of what I've read and heard, and that could mean that we go back into a cycle of load shedding, which is not good for the economy, and it's not great for investment either. Right, then South Africa incorporated stocks, SA Inc., our domestic stocks, so I think banks, possibly retailers, some of your domestic industrials like Bidvest and Imperial and the like, offer selective value. And to that point, I've got a slide coming up where we look at the PE ratio of the all-share index, and I'll show you why I say there's sort of selective value evident. This is our all-share last 5 years, and I mean, it's not a very pretty picture. As you can see, this market really has just gone absolutely nowhere for the last 5 years. And I mean, actually, my brother spoke to me this morning. He's not a financial guy, he's not in the markets, and he just said to me his pension fund has done nothing for 3.5 years. And I said to him, well, look at the all-share index, and I showed him this chart. I said, that's why your pension fund has done nothing for the last 3.5 years, because look at what the market's done. We still sit at the same level as we were back at the start of 2015. As things stand now, we are starting to see some evidence of the market looking as if it's trying to move higher. But from a technical perspective, this 55,000 area on the all-share index is quite a significant resistance. So if we do move up to that sort of area, then I think it's going to be interesting to see whether the all-share can break through there or whether it falters and then consolidates and pulls back. 55,000 is going to be a very, very big line in the sand this year for our market. This is the chart of the all-share index PE ratio. Now, what's evident here is that although our market's gone nowhere for 5 years, I mean, let's just have a look at that again. There we can see effectively 3.5, 4 years of nowhere on the all-share index. On the all-share index on its PE ratio, and these lines, the middle line there shows you the average, and then the dotted lines indicate the standard deviation around that. So with the all-share index index PE back at 16 now, we're not expensive. We're not cheap either, but really we are sort of the cheapest levels I've seen over the last, call it 5 or 6 years. Not to say that it can't go cheaper though. I mean, we've seen it cheaper in 2011, 2012, and of course in the financial crisis we saw it much, much cheaper. But our market is not expensive. 5 years of going nowhere has also allowed earnings to catch up, and it's actually allowed the PE ratio on the overall market to unwind to a certain extent. All right, then let's look at the risks locally in 2019. So I think the fact that we've got this wait-and-see approach ahead of the elections in May means that our economy probably continues along at stall speed, and that is not great news. The economy is already on its knees. We really do need things to start picking up. The prospect of another 5 months of going at stall speed is actually quite frightening, because I do get the sense a lot of businesses are really at the end of their tether in terms of being able to survive as things stand at the moment. The other risk is, of course, the downgrade to full junk status. I suspect that when Moody's next meets, I think it's after the budget sometime, but before the election, if I'm not wrong, my expectation is that they will they'll move us to negative outlook, because I think at the moment we're still on a stable outlook, but I think they would move us to a negative outlook, and then possibly depending on whether we're able to get our house in order or not, after that maybe a downgrade to full junk status later in the year or early 2020. I think another tax collection shortfall is a very real possibility. We saw that last year where the tax collection missed revenue estimates by a long way. Given the weakness that we've seen in the economy this year, given the fact that we were in a recession for 2 quarters of last year, that to me suggests that tax collection is probably going to come in short this year as well. We won't be able to escape a global slowdown, as I mentioned. If we see the US and China slowing down, we will not be able to escape that. The other risk is then, of course, that load shedding keeps our economy at stall speed and it discourages investment into the economy. All right, but the big but to all of these points is that most of these risks are known and they probably are priced in already as things stand at the moment. So, if any of this stuff does happen, it may not necessarily come as a massive shock to the market. All right, then let's look at the action plan. This is for an action plan that I essentially set out for myself to try and adhere to and follow from a bigger picture perspective, and sort of from the terms of the way I'm treating my own money this year. So the first thing is that the market is likely to be volatile. We already saw it becoming very volatile in the second half of last year, and in fact throughout 2018 it was reasonably volatile, but particularly in the last quarter it got very volatile. So I think the key is to be prepared for that volatility and to trade it. And to that extent, I'm looking to fade the extremes. So I think you will probably find there comes a time fairly soon where markets do move a bit higher and everyone starts to turn bullish. The commentary might start to turn bullish. But given the backdrop that I've painted through the presentation and the risks that I see, I suspect that just when everybody turns bullish, you could actually find that is the time where you want to fade that bullishness and look for an opportunity to go the other way. So, for example, if we see a resolution to the government shutdown in the US, and we maybe see some positive developments in the US-China trade war negotiations, that could potentially be, those could be catalysts that push the S&P 500 up into that zone that I mentioned, that 2700, 2750 kind of area where the underside of the 50-week moving average comes in. And that's possibly where I would then look to begin putting in some sort of short position. I might do it via options. As well, if you see any extreme weakness, you're probably also going to be looking at opportunities to buy into very extreme weakness as well. Because like I said, you can get quite big bounces during bear markets as well. Keep in mind, most bear markets last between 18 months and 3 years typically. So if indeed we are in a bear market, and I'm referring specifically to the US here, then it's still very much in the early stages. I mean, that 50-week moving average on the S&P 500 has only just begun to turn negative now in December. So it's very, very early days in terms of a potentially bearish environment, if indeed we are in a new bear market. Also remember that prior major bear markets typically ended in panic. We haven't seen proper panic as yet. I mean, in December we saw the US markets down 20% off their peak, but it certainly didn't feel to me like people were panicking. If you've been in the market a long time, look at what happened in 2008 and 2003. If you get that type of a panic situation, to me, that would potentially be the time that you'll ever see. So I'm hanging back for that potentially. I want to keep dry powder for this year to take advantage of any market weakness. So I'm keeping my cash levels very high. Personally, where I've been most of my investments are positioned actually is in US dollar cash. I've gradually been exporting money out over a number of years, and it's been the vast majority, more than half of it, has been sitting in US dollar cash over the last year. I'm pleased because that actually was the one and only place really that you could have hidden last year in the equity markets. And having that dry powder, of course, gives you the opportunity to take advantage of opportunities when they come around. Draw up a shopping list of stocks and ETFs that you want to buy into weakness for your long-term portfolio. I think it's very important because often what I see happening is, not often because these opportunities don't come around often, but if you get a situation where there is some panic in the market, you actually want to have your action plan set out in front of you so that you know exactly what you need to do and what you need to be buying. You don't want to be panicking when things like that happen. Yeah. All right, but in the interim, while we wait for all of this to happen, I'm going to be looking to trade actively with careful risk management, of course. As I said, the volatility is around, and volatility does present plenty of tradable opportunities. So while we're in this volatile environment, which is somewhat uncertain and somewhat nervous, there will be plenty of trading opportunities within that. And I'm going to be, that's where I'm mainly going to be looking to spend my time, energy this year, is actually with shorter term trades with careful risk management, but obviously also keeping the bigger picture in mind, having dry powder to try and take advantage of any significant weakness and really deep value opportunities that might present themselves if my overall thesis is correct. All right, so that's it. What is the time? 1:15. So we've got about 15 minutes left now for questions and answers. It's over to you. I see we do have one question in the box already, but if you have questions, please feel free to pop them in the question box and I'll address them each one by one. I'll bring my charting system onto the screen in case there's any technical get asked. So focusing, it's the yield difference between the 2-year treasury yield and the 10-year treasury yield. That's what I'm referring to, and that's what they refer to as the yield curve. And when they talk about the yield curve flattening, that's where your 2-year rates start to approach your 10-year rate, so that the differential between the two begins to decline. That's what you talk about, a yield curve flattening. Then Fred asks, what is on my shopping list for this year? So Fred, most of stuff that's on my shopping list for this year is actually overseas stocks, and the reason that is the case is because like I said, I've positioned most of my investment capital overseas in offshore markets. So what's left in South Africa is not much, and most of it is, I'm actually pretty much invested already in South Africa, largely because I've been involved and had positions for a long time, since the early 2000s, 2006, that sort of time. So I haven't sold any of those long-term positions. So I'm fairly full in terms of South Africa. The shopping list is offshore, and I'll quickly run the list. I'll run you through the list. Amazon, AstraZeneca, British Land, and that would be if we saw, a hectic sell-off in the British, in UK property stocks, more hectic than what we've already seen now. Diageo, GlaxoSmithKline, Google, Hammerson, Janus Henderson, that's an asset management business, British Land, Land Securities, that should say, Legal and General, Lloyds Bank, Merchants Investment Trust, Murray International Investment Trust, Schroders, Standard Life, Aberdeen, Unilever, Reckitt Benckiser, and Nestle. Those are, I think there's 20 stocks there, if I'm not wrong, and those are the shares on my shopping list. If you didn't get all of those and you want them again, you can pop me an email, garth@traderscorner.co.za, and then I'll email that list to you if you'd like it. Otherwise, I know this webinar will also be recorded, so you can listen to it again if you want to. Okay. What is next? What is my view on a long trade on Bidvest? That's Andrew Harrison asking that. All right, let's have a quick look at the chart of Bidvest. I know it does look quite constructive to my mind. It's we've got, let's see, from a trading perspective and from a technical analysis perspective, it looks as if it is now trying to break to the upside today. As I see it, that is sort of starting to look good. It's potentially breaking higher here. I think you've got pretty solid support down here at about 200 Rand. It seems to be holding that. So my my sense is that while it holds 200 Rand, it's probably bullish. It can probably go a little bit higher. So from a short-term trading perspective, I think Bidvest does look quite interesting. All right, then let's have a look here. Mel asks, expectation of where gold will end 2019. Gold certainly is starting to look a lot better on its technicals. Let me just go and get you a chart of gold. It is looking a lot better. And if you believe the US dollar goes weaker, that would help gold. But as I said, I gave you my thoughts on the US dollar. I think it's sort of it's just chops around. Technically, here's your chart of gold. Let me just put it onto my template so that it gets rid of all this other. Right, here we go. So this is a weekly chart of the dollar gold price now. So what's very significant here is this overhead resistance zone at about 1350, 1360, that sort of area. I would think it's probably going there at some stage this year. And then if it is able to get out above that overhead resistance, then that'll be very bullish, because that'll mean then it's basically broken to a 5 or 6 year high, and that probably then opens a fairly swift move to the upside, where your next major resistance comes in here at about 1550. So I think near term the chart of gold looks like it can still go higher, but it really needs to break above 1350, 1360 to open a significant move to the upside after that. All right, will listed property market improve or sell whatever I have? That's Danuta asks that. Yeah, the listed property markets come under a lot of pressure over the last year, particularly the resilient stable. Obviously, some shenanigans in that stable. I think listed property generally, there does appear to be somewhat of an oversupply of listed property at the moment. And I've also seen and heard some interviews with CEOs of some of the big lists. They're not increasing rents, and in certain extreme situations, you're even having discussions where the tenant just says, I can't even afford to pay the current rent. I need you to drop my rent by 10% so that I can stay in business. And the landlord says, well, we'd rather have some money than no money, so let's agree to that. So I think listed property remains in the doldrums for the time being, but it will recover, and I'm fairly confident that it will eventually recover. But I think it's one of these situations where you need to just be patient. Do also keep in mind that listed property obviously pays you very healthy, handsome dividends every year. So while you're waiting, you're at least being paid to wait. Right. Fritz asks, will I be doing an overseas webinar? No, Fritz, I don't have specific plans to do that. I'm not sure if you've watched my prior webinars in previous months, but what I typically follow every month is a template that looks at overseas markets as well as local markets, and I'll revert back to that normal template from next month again. So you will get some coverage of offshore markets from next month again. So I hope that answers the question there. Helena Grief asks, what is on your shopping list for your son's long-term portfolio? Yeah, my son's portfolio has gone, I've been very quiet about it because it's been in the last 2 years. Same stuff, overseas stocks. If you didn't catch that full list and you want me to send it to you, you're welcome to pop me an email, garth@traderscorner.co.za, and then I will send you that list of stocks that are on my shopping list. Okay, then could gold still be a traditional safe haven in the current global environment? And that is from Carleen. It seemed to be acting as a safe haven again. I mean, I was doubtful in the middle of last year that gold's safe haven status still existed, but the way it's been performing over the last couple of months suggests to me that the safe haven status is actually still is returning. So yeah, seems like it. Okay, Peter Jones asks, what is my view on long for life? Let's get that up quickly for you, Peter. Okay, here's your chart on long for life. Look, it hasn't been a particularly good performer since it listed. I think it's one of these companies that Brian Joffe by the Brian Joffe magic. Area to open a little bit more upside. Fundamentally, I don't know what to say about it. I mean, I think it needs a more accommodative and healthy economic environment in South Africa. All right, Jonathan Smith's asking expectations for the construction industry. Again, it also goes back to the economic situation in South Africa, particularly. I'm not much of a bull on construction in South Africa, I must say. I really am not. None of those companies excite me at all. Right, then Alistair McQueen asks, what about ShopRite and Coronation? So Coronation is one of these stocks you want to own Coronation in a bull market. You definitely don't want to own it in a bear market. And here's a very clear case in point. Notice how poorly it performed last year. I mean, it dropped by 50% last year. It does pay you a very, very healthy dividend yield. So I think there will come a time where you do want to own Coronation. And what I would do is look for this chart structure to start showing some sign of a base, and then start looking to accumulate it into weakness. And while you wait, you will get paid very healthy dividend. But these are the kind of stocks, if you really want to supercharge your performance in a bull market, own your asset management stocks. And that's why amongst that list of stocks that I read out to you, there are things there like Standard Life Aberdeen and Janus Henderson and Schroders and those kind of companies. Those are global asset managers. Those are those stocks overseas. Asset management stocks have also been beaten black and blue during the last year. But I'm a firm believer that if we do return at some point to a more favorable and bullish, the kind of shares that you do want to own. Here we go with ShopRite. The one thing I will say about it is that in the South African retail space, it has been underperforming the other retailers in quite a big way. Generally speaking, I've always liked ShopRite. I think it's a well-run business. Their margins are much fatter than a Pick n Pay, for example. They've got the African expansion. They've led the march on that, etc., etc. Broadly speaking, I do like ShopRite from a longer-term perspective, but I will say, it's quite clear here that it's underperforming the rest of the retail sector quite horribly at the moment. Then Patrick Royal, do the FANGs still have upside? Yeah, the FANGs, for those who don't know, FANGs is Facebook, Apple, Amazon, Netflix, Google. That's the acronym for those big tech stocks that have really led the charge on the US markets in the sort of latter half of last year before the big sell-off. Is there more upside for those? I think that they've entered into a period now where they're going to remain very, very volatile and very choppy. I think that big crack that we saw last year on those stocks was probably an indication that the major bull market in those stocks has come to an end for now, and that you're going to see further choppy action. Many have termed the FANG area of the market as a bubble, and I sort of fit into that camp as well, thinking that it was a bit of a bubble. And I think that the bubble burst when the market cracked heavily in October through December of last year. All right, I don't have a huge amount of time left. We've got 2 more minutes, so I'm going to just take as many of these questions as I can. Grant asks, you mentioned Hammerson. What trigger are you looking for in what appears to be value now? Yeah, Grant, that's a great question, actually. What would be the trigger for Hammerson? Look, I have already started buying it. I will say that. I've already started accumulating Hammerson because the discount to net asset value there is absolutely enormous. Also, do keep in mind that there was quite a lot of potential corporate action around some of those UK-listed property stocks last year. We saw it potentially for Hammerson, where the French came looking and came sniffing around, and then that fell through. And also with Into, there was twice they've been courted for corporate action. Both times the suitors have walked away because of the risks around Brexit. So I suspect what could possibly be a catalyst would be if some sort of resolution to the Brexit situation, maybe a soft Brexit, or maybe a second referendum, or maybe Brexit that doesn't ever happen at all. Who knows? It's so up in the air at the moment. In the meantime, I think there's very deep value in Hammerson at these levels, and I've started to accumulate it already. All right, I think that's all that I have time for, unfortunately, today. It is 1:30, so I can't take any further questions. The hour is up. But thank you very much for your time. We had a great turnout today. I think this was the highest turnout that I've ever had on one of these webinars, so thank you. I'll be back with you next month sometime. We haven't scheduled the date yet, but from next month, I'll return back to my normal global markets and the local indices. And my email is garth@traderscorner.co.za. All right, have a good afternoon, everyone, and a good rest of the month, and I'll catch up with you again in February. Thanks, cheers.